to another training from Larson Statutory U. Today, we'll be going over Life Insurance 101. I'm Tori Nickel, Audit Manager at Larson, and I've been with Larson for almost 6 years and specialize in life insurance auditing. For this training, we'll be going over a very basic high-level overview of life insurance and life insurance accounting. We'll start with general definitions, life insurance overview. We'll go through recording the journal entries for premiums, reserves, and claims, and then also some unique aspects of life insurance, including reinsurance and investments. We'll also be going over the differences between statutory and GAAP for life insurance. First, general definitions. These general definitions will become important later on in the training and will be referenced. So first is the National Association of Insurance Commissioners, or the NAIC, and they are the governing body for insurance companies. They oversee the insurance company's accounting. Next is the Statement of Statutory Accounting Principles, or SAPs. This is accounting guidance for insurance companies. These are specific accounting rules that insurance companies follow. They are different from GAAP. Next is admitted assets. These are assets that could easily be used to pay claims. And this is unique to life insurance accounting and insurance accounting, where insurance companies take a very conservative approach to how they account for everything. And one of them is showing assets that can be used for future claims. And we'll be going over that more later. Next is non-admitted assets. So these are assets that cannot be used to pay claims, and therefore they're removed from the company's statutory balance sheet. So generally this includes furniture, or other properties that can't easily be converted into cash to pay claims. Next is reserves. This liability for future obligations to pay claims. Again, this is following the conservative accounting to show future liabilities that the insurance company might have to pay claims. And then next is reinsurance, contracts that help insurance companies transfer risk. And we'll be going over that in more detail later. So next, we'll be going over life insurance quick overview. What is insurance from the NAIC? Insurance is an economic device transferring risk from an individual to a company and reducing the uncertainty of risk via pooling. So you're transferring your risk to this company, specifically financial risk or financial loss. It doesn't reduce the risk of getting into an accident or a life, but it reduces the risk of suffering financial loss related to an accident, for example. In life insurance, so the insurer guarantees payment of a death benefit to the named beneficiaries upon the death of the insured. So you purchase life insurance policies so when you pass away, your beneficiaries will receive financial help, therefore reducing their financial loss or financial risk. Now this graph, a lot of the ways accounting is done is based on how risk changes over time for life insurance. So how does time impact risk? So this first line shows risk for a relatively healthy individual who has purchased a life insurance policy. Risk starts out low beginning and over time it increases as they get older. Next, the blue line shows a relatively unhealthy individual. So risk is higher and then slowly increase over time. But for life insurance, it's unique is at the end of the day, the claim will always be paid out in the majority of life insurance policies. And so you can see it. Risk ultimately comes to a point. And a lot of the way the accounting is done is based on this concept. It's how they account for premiums, reserves, and claims is how risk changes over time. One thing to note too is life insurance usually covers a long period of time. And so that a lot of the way that's accounted for is over that long period and how they account for that. Here are common types of life insurance policies. First is term life, this policy that covers you for a set period of time. Usually it's 10, 20, 30 years. And at the end of the period, if you haven't passed away, it does end. If you pass away during it, you get paid out. Permanent life or whole life provides, well, there are two types of permanent life. There's whole life, and it provides permanent coverage that lasts a lifetime, as well as a guaranteed premium and cash value. So this is no specific set of time. There's a set premium amount, you pay over time, and you accumulate cash value of the policies. Next permanent life is universal life, and this is similar, but it provides more flexibility than whole life. Next is limited pay life. So lifetime of benefits, not a lifetime of payments. So there's a certain point in time you pay for policies and then you stop those payments, but the benefit is always there. Throughout the training, there will be some questions to help keep you engaged and to test your understanding. So first question is, what type of life insurance policy has a 10-year term? Here are some options to refresh your memory. And it is term life. So it has a specific term that it ends, which can be 10 years. All right, next we'll be going over premiums. So we'll go over some definitions, journal entry examples, and then how it looks on the financial statements. So some definitions, there's direct written premium. These are amounts charged to the policyholders for insurance coverage that does not include reinsurance. This is just direct written premium that is charged to the policyholders that the insurance company receives. Next is gross premium. So these amounts are charged to the policyholder and taken into operations as premium income, and they can include assumed reinsurance, which we'll go over later. Next is net premium, amounts calculated on the basis of interest and mortality table used to determine statutory reserves. So net premiums is how they determine those liabilities for future claim payments or those obligations for future claim payments. And because of that, they have a big impact on how premiums are recorded for a life insurance company to match those reserves with those net premiums. Next is loading. So this is the difference between gross premium and net premium. Usually includes allowance for acquisition costs, other expenses, and profit margin. So as we go through journal entry, the journal entries of recording premiums, it's important to know the difference between net premiums and loading. So as you can see here, gross premium includes the net premium and loading, which is those expenses and profit margin. And you can see net premium is lower than gross premium because it's just the premium, not related to loading or profit margin. And the net premium is what they actually use to record reserves. So they match the reserves for net premium, not the reserves. The reserves are not matched with gross premium. Another definition, so earned premium. This is similar to earned revenue, so a portion of the written premium applicable to the expired portion of the policy term for which the insurance was in effect. So actual earned premium for the year. Unearned premium, similar to unearned revenue, is the portion of the premium applicable to the unexpired period of the policy. Then there's advanced premiums, or similar to advanced revenue, premium received prior to the reporting date, but which are due on or after the net policy anniversary date. All right, question 2. So what does this equation equal? Policy premium times expired coverage days divided by total number of days in the policy equals what? and it is earned premium. So it shows total premium that has expired over the days and what portion of that was earned. All right, so before we get into the actual journal entries, there are some assumptions that are made for life insurance. So the life reserving methodology assumes all policies have been issued proportionately throughout the year and all policy premium have been paid off through the anniversary date. So the anniversary date is the date that the policy started. So let's say a policy started in July. And it assumes that the entire premium has been paid for that year, starting in July, assumes that it has been paid. Next assumption is this requires an asset to be recorded to recognize the net valuation premium that is due and unpaid and deferred from the valuation date. So the valuation date, another term we use is reporting date, which is usually the end of the year, so 12/31. So we assume it's been paid for the whole year, but if it starts at July, at the reporting date in December, there needs to be an asset recorded for that second half of the year, since we assume the whole thing has been paid. This simplifies the reserving methods for life insurance, and then it matches those reserves with the premiums. With that, let's get into an example. So premium example, here's some assumptions. It's a whole life policy. It's a monthly premium mode, which means it pays the premium monthly. There's a $100 premium, $80 is related to net premium, and then $20 is related to loading. So if you remember that graph we showed, that splits the premium between net and loading. The effective date is July 1st, 20X1. And the face value is $10,000, and that will come more into play when we talk about claims and reserving. So here's the initial billing. So we haven't collected the cash, but we're billing for premium at July 1st, X1. See, we have premium due, but uncollected. So we debit $100 for the premium, goes on as an asset, as a receivable. And then there's the revenue of $100 life insurance premium. Next, we need to record the loading, which change in loading is an expense decreasing the income statement, $20. Then premium due but uncollected goes into a contra asset account. You can see total for the journal entry. So we're only recording net premium at the end of the day, although they're recorded on different lines of the income statement. Next, we record the receipt of the monthly premium. So say on the 15th of 20X1, they pay to receive cash, increase cash. We reduce the receivable, premium due but uncollected, and then we reverse the loading. Next, let's do the December billing. So same $100 in receivables, $100 into revenue, and then also recording the change in loading. So we record the net premium. And again, receipt of premium, we can see they paid $200 instead of the $100. So there's going to be an extra $100 in advanced premium. So we don't record revenue until time is actually passed for the policy. So $100 of it will be recorded into advanced revenue as a liability. And then also the loading. And see, it's the loading just for that period. So just that $100 in revenue, not the $200. All right, we're at the report date or the policy issue date. So remember, the policy was issued in the middle of the year. So we need to record 6 months of deferred premium to match the reserve assumption that the entire anniversary year was recorded. So that's what the $600 is for. And then also we need to record the loading related to that as well. The very next day in 20X2, January 1st, we reverse these journal entries. Generally, the deferred premium and loading is only recorded at the end of a reporting period and then reversed the next day. Next question, loading is recorded as a contra asset and netted against what in the statutory financial statements? So again, we just went over this and it is deferred premiums. All right, next we'll be going over reserves and claims. So again, we'll be going over some definitions and then also the journal entries, and notice how we match the reserves to the net premiums that have been paid. So some more definitions, policy reserves. So this is a liability established for all contractual obligations for the reporting entity arising out of the provision of the insurance contract. So these are liabilities for future obligations to pay these claims. You know these claims are going to be paid. So following the conservative approach, we record it as a liability on the balance sheet. Next is incurred but not reported losses, or IBNR, it's often referred to as. That's expected payment for losses related to insured events that have occurred but not been reported. So generally, when a person passes away and they have a life insurance policy, the insurance company does not know about it until a certain amount of time after. And so they need to record any deaths and claims they need to pay, but they haven't been reported. They don't know about it yet. So they need to record that, again, following that conservative approach that insurance companies follow. And that is estimated by the actuary. Next are loss adjustment expenses, or LAE. So all the costs associated with the settlement of the claim except the claim payment. So this includes adjusters or litigations, everything except the actual payment of the claim. Claim definition, so benefits paid are the total amount of checks or drafts issued in settlement of claims under the insurance provided by the company, so the actual claim cost. Benefits incurred is the amount that represents losses paid plus the change in claim liability or the change in reserves. So when you increase reserves as a liability, you offset that. It runs through the income statement as benefits incurred. All right, question 4. Blank is the expected payment for losses relating to insured events that have occurred but not yet been reported. To be clear. And yes, incurred but not reported, or IBNR. All right, next, we're going to be going through the death claim example. So this is the same policy, face value of $10,000. It was effective July 1, 20X1. We went through the premium payments for that first year. The death date is 3.5 years later, December 20th, 20X4. The report date, so the date that the death was reported to the insurance company that they found out about it, was December 28th, 8 days later. Then the day that the insurance company paid the claim was January 29th, a month later, after year end. So let's go through the journal entries. First, we're going to record the initial reserves at the reporting date of the first year. So again, we're matching the reserves to the net premiums. So usually reserve adjustments are only made at report date or valuation date. So you can see this is 12/31/20X1. They're not recorded at anniversary dates. Usually at report dates are when actuaries review the policies and determine the reserves. And because it's, for example, this is a new policy, it's considered lower risk since it's new. You remember the chart, it was low risk. So only a $500 reserve is required. And this is determined by the actuaries. Even though there is a $10,000 policy, only $500 is recorded in reserve since it is a low risk. And I want to point out too, you can see reserves is a liability. It increases by $500, and the debit runs through the income statement as a change in reserves and as an expense. All right. It's the next year, 20X2, end of the year, it's a reporting date. You can see the actuaries reviewed the premiums and claims and determined that there's a higher risk. So the reserves for this certain policy needs to increase by $1,000. Next year, 20X3, you can see another year's gone by and risk increases, so life reserve needs to increase as well by $1,000. So total reserve at the end of X3 related to this policy is now $2,500. All right, remember from our assumptions, December 28th, the policyholder dies. This is how we record the death claim. Now remember, the date of the death was December 20th. However, insurance companies do not record the claim until they are notified of the death or the report date. So you can see the date in the journal entry is December 28th, X4. So we record the benefits paid or the claim paid to expenses of $10,000, which is how much the policy was worth, and then reduce the contract liability, or since it hasn't been paid yet, we put a payable, the liabilities of $10,000, so contract liabilities for life. End of the year, what do we do with reserves? Remember, we had total reserves of $2,500 related to this. So we need to remove that from the balance sheet since we're actually paying it, and the offset is gonna run through the income statement. So you can see it's a debit of $2,500 to life reserves, removing that reserve from the balance sheet, and then flows through the income statement as a contra expense. All right, so next month, remember in our assumptions, it was paid January 29th. So it's gonna remove the payable from the books, the $10,000, and then credit cash that was actually paid out. Question 5. So following this equation, what does it equal? Payments during the year, less claims liability in prior period, plus claims liability in current period. The answer is incurred benefits. So this takes into account the changes in reserves for the current period. All right, reinsurance. We'll be going over basic definitions for reinsurance terminology since it impacts all life insurance companies. However, at Larson Statutory U, we do have a separate training for reinsurance that goes into more detail. All right, some definitions. So reinsurance, this is the transaction whereby the reinsurer for consideration agrees to indemnify the ceding company against all or part of the loss, which the latter may sustain under the policy or policies which it has issued. So a reinsurance contract is to reduce risk for the life insurance company. So let's say a life insurance company enters into an agreement that the reinsurer will take 50% of future losses. So when an individual passes away and the insurance company pays $10,000, like in our example, 50% of that, or $5,000, goes to the reinsurer and pays the insurance company for that. Reinsurance assumed is a portion of risk that reinsurers accept from the original insurer or ceding company. So this is the company that takes on the risk from a different life company. So takes on that risk. Reinsurance ceded is a portion of a risk the ceding company transfers to the reinsurer. So that's the life insurance company with the policy cedes or transfers that risk to the reinsurer. Next, we'll be going over investments and some unique things for life insurance. We have a separate training on investment insurance accounting as part of Statutory U. Encourage you to watch that as well. Life insurance policies last for a long time, so remember. So the accounting guidance helps the insurance companies meet those needs with investments over that long period of time. So following that same understanding. First, what's unique is the asset valuation reserve. So in the SAFs, it notes that EVR is intended to establish a reserve to offset potential credit-related investment losses on all invested asset categories, excluding a select few. So the NAIC provides a calculation based on information from the investment portfolio to calculate this AVR. And AVR is carried as a liability on the financial statement rather than a reduction of the carrying value of the investment. So it's a separate line item. The liability considers almost all categories of invested assets, including those select few. And it's noted on page 3, line 24.01 on the annual statement. One thing to know about AVR is it runs through equity and surplus. So the change in AVR runs straight through equity. It does not hit the income statement. And this is a protected reserve, specifically for future losses for the investment portfolio. So for example, if you have a riskier portfolio, your AVR is going to be higher for future potential losses on those investments. And again, it follows this conservative accounting, taking into account future losses, similar to reserves, taking into account future claims. Follows that same understanding. Next is something unique for life insurance is the interest maintenance reserve, or IMR, for investments. So the interest maintenance reserve is deferred income account for interest-related gains or losses arising in the sale of a fixed income asset before maturity. So these gains and losses are to be amortized into income over the remaining life of the security sold, and it is carried as a liability, net deferred gains, or a non-invested asset if it has net deferred losses. So again, this shows on page 3, line 9.4 on the annual statement. An example of this is if an insurance company sells a bond before it matures and there's a gain. Say the bond is for 10 years, they sell it at 5 years, and there's a gain. That gain is going to be amortized across the rest of the life of the security. So for that 5 years until it matured, that gain needs to be amortized through the income statement for those 5 years. And again, just following the conservative approach of insurance companies. All right. Next is question 6. So the blank is intended to establish a reserve to offset potential credit-related investment losses. And the answer is AVR. So again, this is if you have a riskier portfolio, your AVR is going to go higher for future potential losses. All right, last section we're going to cover is reporting stat versus GAAP. We have another training that goes into more detail for general insurance companies. For this training, we'll just be going over a highlight of unique life insurance stat to GAAP. This does not cover all of the stat to GAAP differences. Refer to that other training with Larson Statutory U, but we will go over some important ones. Here are the ones we'll be going over. We'll start with non-admitted assets. This was mentioned earlier in the definitions. at the beginning of the training, this is very unique to life insurance accounting. So non-admitted assets are assets that cannot be used to pay off claims. So again, usually furniture or equipment. And this is following the same conservative approach. The balance sheet shows how they can meet the future obligation of claims or what assets can be used. And for GAAP, there is nothing like this a part of GAAP. This is solely uniquely to statutory accounting. Similar to non-admitted assets is deferred taxes. So if a DTA gets large enough for stat, you need to go through the calculation of if a DTA needs to be not admitted or not. And GAAP does not do this. Next is due and uncollected premium. So if insurance company under stat has a receivable that is over 90 years old, it's automatically not admitted. Even if the insurance company thinks they're going to receive the receivable, if it's over 90 days old, it cannot be recorded as a receivable. GAAP does not have that. You can record it as a receivable. Next is contract acquisition costs. So this is generally commissions associated with issuing policies. So for statutory, those expenses are charged to expense when they are incurred. So when a policy is sold and commissions is paid with that, all of the commissions is expensed through the income statement. For GAAP, that commission expense is recognized over the life of the policy. It's not expensed up front. It goes through the income statement year over year, amortized over the life of the policy. So for statutory, they have a front heavy expenses, whereas GAAP, it shows it over the life. Next is surplus note. For statutory, surplus notes have to be approved by the state insurance commissioner. And if they are, it's recorded as a loan in surplus instead of the liability section of the balance sheet. These are usually to help insurance companies meet their surplus requirements, and they are very heavily regulated. Interest payments also need to be approved by the state insurance commissioner. In GAAP, any surplus notes are recorded in the liability section of the balance sheet, not the surplus, and that's the difference there. Next is consolidation. Majority-owned subsidiaries are not consolidated under stat. And so consolidation does not apply. Annual statements only show one company. For GAAP, it is required to consolidate for majority-owned subsidiaries. All right, question 7. Contract acquisition costs, according to statutory reporting, are expensed when? Again, these are commissions. When are they expensed under stat? And it's as incurred. And that's all we have for Life Insurance 101. If you have any questions, please contact me or anyone a part of our team. And thank you for watching.